We think the Fed is pretty much got their finger on the trigger and is ready to move, and particularly because the U.S. economy is holding up rather well. The domestic side is looking good. Jobs are coming in. We now have about 230,000 job gains per month for the year. What has held the Fed back is what's happening on the international picture. The Eurozone worries, and of course the worry of the strong dollar impacting exports and also importing some of that deflationary environment to the U.S. is one of their concerns. You can expect to see home mortgages picking up just a tad. Also, business borrowing might get a little bit more expensive. That could slow down demand for access to liquidity or money in order to spend elsewhere, having a little bit of an impact on the economy, slowing it down somewhat, but rather small. We're expecting, about 4 more rate hikes next year. That would bring the interest rate for the federal funds rate to about 1.25 in the range, probably by year end. That again brings it pretty much kind of where it would be kind of normal, still very low recessionary monetary policy in our mind. It'll take them a long time to get to the so-called exit rate for the federal funds rate, which they say is 3.25 or 3.5, probably until late 2018. So they're going to take their time. Given that the U.S. recovery, while we're very happy to see a growth rate of, say, 2.5% that we expect for 2015 and a little bit stronger for 2016, keep in mind the year after a recession ends, the United States historically had seen an average growth rate of around 5%. So this recovery is still rather slow.